We are here on the Energy Perspectives podcast at the North American Gas Forum, hosted by Energy Dialogues. It's a very informative section here that we've had today. Thanks to my speakers. Would you please go ahead, Victor, and then David, introduce yourselves.
So I'm Vic Pascucci. I'm the Managing General Partner of Energy Capital Ventures. Energy Capital Ventures is the only early stage venture capital fund that's solely dedicated to the energy expansion, as it's enabled by the innovation and resilience of the natural gas value chain. In addition to this unique thesis, which makes us advocates for innovation that we've defined as green molecules, we further differentiate ourselves with a customized engagement and deep integration with our corporate limited partners, all of whom are key energy companies in the natural gas industry. It's this model where we take the innovation of the startup ecosystem, combine it with the scale of the energy.
The innovation of the what system?
The technology ecosystem.
Yes, thank you.
With the scale of the energy industry to make some great game-changing generational companies that are responsible for the clean, safe, reliable, cost-effective energy of the future.
Fantastic.
David Finan, Managing Partner at EIV Capital. We focus on lower to mid-market energy infrastructure across both the renewable space and traditional energy. In general, looking for assets and projects that can provide predictable long-term cash flow returns over time.
My name is Diana Glassman. I'm Director of Engagement at EOS at Federated Hermes Limited. We are part of an investment management firm. Our group provides stewardship services, meaning we work for pension funds. These are what's called universal owners that invest in equities, fixed income, and private markets around the world. We have about 70 clients, $2.2 trillion of asset under advisement. My job is to work on the technology sector, the energy sector, the two have happily converged, and I also do a lot of work in financial services. Thanks both for telling us about yourselves and your companies. Could you give us a very brief example of a type of investment that you make to illustrate for our audience how you work?
So for us, green molecules encompasses all the innovation that's relevant to the future of the natural gas value chain. Right. So for us, that's everything from turbo expanders, gas membranes, and methane management, out to hydrogen, RNG, CCUS, and biofuels. So those are the areas within which we're investing.
And how did you add value? What value do you add to these companies?
You know, at the end of the day, when people ask me that question, and we're asked a lot by folks in your position, I just say, talk to our CEOs, see what they have to say. And I think what they'll tell you is we're the first call they make. Okay. When it comes time to big strategic decisions, whether it's business development, HR, financing, whatever it may be, the topic of the day with early stage companies, there's lots of topics, right? There's always something. And we're the first call they make for that advisement. Also, there's the benefit of having an LP base like ours that are these leaders in the natural gas industry, right? So we can bring those people together, have those discussions, talk about product, talk about industry, talk about regulation. And it's that great mix when you bring people that have been supplying natural gas for decades and decades with someone who's at a TRL 3 that just started with their technology.
Thank you. And I suppose that's also your value proposition for the LPs, the limited partners,
exactly.
Your investors.
Right.
Same question for you. Give us an example broadly.
I'll give you a couple of different examples.
Please.
So on the one side, we'll have joint ventures with large interstate gas pipelines traversing multiple states. We still own one of the largest private gas gathering and processing business in the Midland Basin. And then we also do dairy renewable natural gas. So it's across the full value chain. And I think where we provide a lot of value is consistency of that stewardship. So especially when you're thinking about transition to traditional or backward or vice versa, it's bringing kind of best in class operatorship across all the assets that we manage. Our team is a mix of about 30% engineers and operators and 70% finance folks like myself. And kind of approaching a more focused portfolio, we do 8 to 10 investments per fund. We're providing that service of consistent stewardship to the CEOs who are, given our average check size is kind of 50 to 300 or so. That's at the low end of infrastructure. So it still has a very much a entrepreneurial feel to it. So a lot of the same aspects are true for us, where we are getting those calls around growth and having that kind of 15 plus years of experience in the space at our firm provides that sounding board that our CEOs are looking for.
And what's your check size?
Our initial check is $4 million.
$4 million. Very good. Thank you.
let's just start off with the hyperscalers, get that out of the way. Tell us about how that is impacting your business.
So in the early stage venture side, everybody gets a question as, what is your play with the data centers? If you're in energy, and we're in energy, we don't consider ourselves climate, but we're in energy. So everybody has to have an answer. Everyone has to have that answer as to how are you playing to data centers. And we're seeing interesting things. A lot of things we didn't expect, right? So software for methane management, hyperscalers want to use that to do certified natural gas.
Wait, hyperscalers want to do that to do certified natural gas in their supply chain?
In their supply chain. Okay. In their supply chain. Because some of those hyperscalers are willing to pay a premium for CNG, whereas other customers, C&I base, are not. So we're seeing interesting things there. We're also seeing things like the turbo expander companies, which we always thought were going to operate just as they always have at the pressure drops and spin some free electricity. Now they're taking waste heat off these data centers, spinning it back and creating electrons. So there's been some interesting use cases that's come out of this. It's also made some of the hydrogen and RNG companies a lot more relevant to that space. But it's still a wait and see. It's good to see them driving innovation or the uptake of innovation. But I think we'd still wait and see.
And David, we talked a little bit about the picks and shovels related to AI infrastructure. So what's your perspective?
I mean, broadly speaking, as a firm, the way we look at it is that you had the early 2000s through, let's say, 2020, which was the unconventional shale revolution. Yep. That was supply push to end markets. So producers getting their molecules to market. Now you have around hyperscalers and the scale of hyperscalers, which I view as over the next 10 to 20 years, is a demand pull. And the amount of infrastructure that's going to be needed around that demand pull can easily be as equivalent as it was to get the molecules out of the producing basin. So where we're spending a lot of time on the hyperscalers is really on what I will call the last mile, and it could be the last 100 miles of getting infrastructure logistics to feed, power. I mean, most people think of data centers and they think of, okay, it's a behind the meter power solution. It's also a behind the meter gas solution. Yep. And so you need to be able to pull both of those together. And ultimately, you've got big forms of capital who are going to solve the big problems. But beyond the big problems, there's a lot of medium to small size problems, which still take hundreds of millions of dollars of capital, because it is a fixed asset opportunity. And that's where we're spending a lot of our time.
Vic, have you seen the demand for methane emissions reduction in the hyperscaler value chain?
Right now, what we're seeing from the hyperscalers is they want power and they want it now. So they're asking, that's definitely what I would call a secondary or tertiary question that they're asking. Now, they want the optionality around exactly what Vic just said. They want to be able to say, look, I need power now. Let's start with that question. But then I need to have the ability to tell my stakeholders everything that Vic just talked about.
Great, thank you. And so how are private market capital strategies evolving? Long-held infrastructure investors versus short cycle private markets type investment. What's your perspective? Perhaps you get started, Vic.
Yeah, so on the venture side, you have to think when we're investing, we're looking at a 10 to 15 year window before you're going to see generally a big liquidity event. It's just taking that long for companies to evolve and develop. What we're seeing, we'll start our first fund in 2021, on our second fund now in 2025, give or take. In 2021, you saw a lot of people that were willing to finance, on the venture side even, these large monolithic facilities. $200 million in CapEx. Let's just get it going. And trust us, the demand will come and we'll be fine. And someone else will finance it after us. So don't worry, just keep going, keep building, keep going, keep going. That's all kind of gone away, right? And so you have to, what we're seeing now on the venture side, and kind of how we've always invested, there had to be that pragmatic deployment and capital efficiency that's there. And so more of those modular solutions that you can rack and stack on things that have a clearer path to profitability, a clearer path to have the real energy density that the customers are looking for. So definitely change on the venture side from this, let's just build it and they will come, and don't worry, more money will come in after us, to a much more disciplined, defined capital plan and capital budget for companies.
Yeah, I think on our side, I mean, given we do more traditional energy oriented projects, that traditional energy had such a bad taste in people's mouths, one from poorer returns in the mid-teens, to then kind of a huge ESG mandate in the early 2000s or early 2020s that now you're looking at it, there's a little bit of a re-education around what it is that we do. So I'll give you a good example at our annual meeting. Our macro events that myself and another one of our partners who like our macro talk, it's usually 45 minutes and we get 2 questions. This year it went an hour and a half. And it was a lot of questions from a lot of different people because there's a little bit of that re-education, and a lot of that is they see all of the GPs who come in and they're talking about digital infrastructure and the need for more and more data centers, and now they're going to go, okay, what's the next derivative play off of that, which is the natural gas side. So they're almost relearning that part of energy investing, and honestly, from as a GP talking to our LPs, demand-oriented customers are easier to sell. Because one, they tend to be better, higher credit quality customers.
Right.
And because they're the customer, I mean, everything that Vic just said, that's customer driven, right? So if you're
technology is energy now.
yeah. So if the customer is saying this is what I need, you're providing that solution for them. That's the easier part now to talk to LPs.
So thank you. You mentioned macro. So let's bring that to the macro political side. How are let's call it shifting political winds? How has that impacted your business?
I'll go first.
Okay, because you brought it up.
Yeah.
Please do. Congratulations.
And try not to get myself in trouble. In general, like I do believe LPs are asking for assets that are resilient across, regardless of who is in the White House or in Congress. And if you're thinking about it from a sustainable perspective, sustainability is not just profitability or environmentally sustainable. It also needs to be politically sustainable. So we always try to have our assets more at the state level, so it's a little bit more state legislature driven. But I would say the offset with this administration has been, yes, it's providing, it is tearing down some regulations relative that have stymied capital growth. But the flip side of that is that it's created a lot of capital uncertainty around federal level, like the Inflation Reduction Act, changing that, the One Big Beautiful Bill. That creates pauses in private capital because, especially given our portfolio that's 8 to 10 investments, we can't get one of those wrong.
Yeah.
So we have to wait until I would call the waters have calmed down. Our LPs want us to wait until the waters have calmed down, and ultimately they don't want us making political bets. I mean, that's not what
Have the waters calmed down?
Ish. I mean, yes. Tariffs are probably more impactful around, I would call it, our greenfield projects and trying to nail down where you believe capital costs will be for the next 2 years or so, because normally a project takes 12 to 24 months. And then what are the inflationary impacts of what you need your customers to pay for against that elevated capital cost?
Thank you. Vic, how have the political changes impacted you and your business?
I would, on par, say it's been favorable. If you think about us as a fund, we started our first fund in 2021. So in 2021, we're talking about venture in natural gas. Nobody was having that conversation, right? Every venture fund that was out there was electrify. It's all about electrification, wind, solar, batteries. And we took a very contrarian approach at that time, saying, no, we think the natural gas value chain is really important, both to this country and to the energy. So let's focus on that. And we had some great LPs backing us to do that. So swing around to our second fund that came out in 2024, 2025, people were like, maybe there is something to this natural gas thing. And there's a future and it's going to grow over time. And therefore the innovation to fuel that industry needs to be there as well. So overall, that's been very beneficial for the fund. But I think also, we've, similar to my colleague, we only make 8 to 10 investments in a venture fund. Most people in a venture fund our size would do 45 to 60 and just place 1,000 bets and let them go. We took this contrarian approach again on that, saying if this is the only thing we're going to do is natural gas, we should attract better deals and be better pickers. So these deals are really important to us. So when we invested in hydrogen, it was hydrogen that didn't rely on an unnatural act of the government to support. However, when the government support went away for hydrogen, it kind of painted the whole sector negatively. And so now we're just trying to bring more precision to the view of, like any other technology in any other part of this, there's some hydrogen that's never going to work. right? And there's some that will. And so really orienting people that it's not all in that.
So are you thinking differently about assumptions and scenarios, or are you doing it? Has something changed about the way you do that, or is it just the same as the way you've always done it?
It's been the same for us. Like we've always been bullish on the industry. We always believe strong companies have to stand on their own, right? They have to have the right business plan. They have to have the right capital allocation. You cannot rely on, like, again, we say unnatural acts of science, God, and the government. Like we've been in technology all day. That's what we do as venture capitalists. But if that technology is only going to come if there's a 30-year subsidy attached to it, we're like, that's not where we're going to play. So we really haven't changed.
Yeah,
Please.
I think it's if you're focused on kind of customer solutions as kind of part of what your assets are, like I make our investing probably as, I mean, may have something to do with general intelligence, but like if the customer wants it, they'll give you a contract. If they don't want it, they won't give you a contract.
Right.
And so speculating on the market, I think a lot of people have made a lot of money and energy doing that. A lot of people have lost a lot of money and energy doing that. So the same speculation I would say that you may talk about from a regulatory perspective, if a customer wants it, they'll do it without a subsidy. They'll do it because it's germane to them generating whatever revenue they need. And that's kind of the simplistic way in which we look at it.
Thank you. So let's go back to the customer and demand. And sometimes customer demands are, like in LNG, are driven by regulations, say in other parts of the world. Sometimes customer demand is inherent because companies have greenhouse gas goals or what have you. In your business, how do you see the need for disclosures on greenhouse gas and methane emissions, rules, MRV, EU, CBAM, and et cetera, trade import regulations? How is that? You don't place bets on government subsidies, but yet this exists. How do you balance that all out?
Yeah, I mean, we look for solutions that solve to those exact same things, right? So what's going to bring?
So, for example, what's an example of a solution that solves? Share with our viewers.
One of our, it's bad to talk up your own book, but we will. One of our
I give you permission.
One of our portfolio companies is Highwood Emissions Management.
Highwood Emissions
Management out of Calgary. And they saw that industry-wide problem in the oil and gas industry of why don't we all come together to decide how to do measurement-informed inventories? Not just top-down, but bottom-up. What are our actual methane inventories? Where are they? How can we report to them accurately and defend? And then take whatever is the most appropriate mitigation plans that are on that, right? Most people are doing that with spreadsheets. Or they're trying to cram the solution into some last century ERP program. Nothing's been purpose-built by the industry for the industry. So Highwood brought together 5 of the biggest producers and said, what should those standards be? How can we certify that people are actually OGMP 2.0 compliant? And what's the technology that we can show that both our executives can work from on a day-to-day basis to understand at the asset level what their emissions are, up to the regulators that want to come in and see, or their community stakeholders. So we view those big problems as opportunities for technology to solve.
And the problems are not going to go away. So these regulations are not going to go away,
right?
Irrespective of what.
And it's the whole value chain, right?
Okay.
So, obviously OGMP for the large producers, the E&P companies, but now the distribution companies are coming together on their own standards to do the same types of things. And the transmission companies are coming into those discussions as well. And I think when you can use technology to enable or fix a lot of these challenges, that's where we want to play.
And same question for you, David. How are these opportunities? Are they messing up your investment assumptions? How do you frame this for us?
I kind of look at it more from the, we ultimately, we always start our investment, we're like, okay, who's going to buy this, 5 to 10 years down the road. And ultimately, we like to build assets that a lot of the large cap companies can just tuck in. They're easy tuck-ins for them. So effectively, we always manage them to that kind of ESG framework, however you want to say it, around, and generally within the oil patch, that tends to be emission management. Within our renewables, it tends to be around abatement. And so measurement to us is not, does it take a little bit of extra effort? Obviously, yes. Does it create more value? We think so, yes, as well. And I think we can look across our entire portfolio, and we've got numerous examples of where our direct actions towards abating emissions, more preventative maintenance has made our assets when we brought them to sell more attractive. So there's more buyers. So we're not doing it because someone in DC tells us to go do it, or we're not stopping because someone in DC tells us to stop it. So that's kind of along the lines of what I say, is that you're trying to create a more purpose-built set of assets that the end consumer wants, either in the form of a contract or in the case where we ultimately want to make our monies, which is selling these assets to the buyers that we see who ultimately buy it. And we've got a really high correlation towards that. That level of management and stewardship leads to better values, which is ultimately why our LPs choose us.
Okay. May I ask a follow-on question?
Sure.
We've just heard here at Energy Dialogues the conversation around affordability. Is this focus on measurement, is this consistent with affordability to the end consumer, or does this add cost to the end consumer at the end of the day?
I think it's more, what will add cost to the end consumer is more around the reliability, because I think especially North American consumers are used to going up to the light switch and turning it on and off. So they want that level of resiliency. And the real cost is when it doesn't turn on. And I saw that in Houston during Uri, is like there is actual real cost if there is no power. The fractional cost of reporting, in my mind, that's not a real driver of cost. It will help regulators understand kind of what the environmental impact is of different forms of emission. But ultimately, I think it is like a large data center that's a gigawatt data center. If they're pulling off of the grid, that will add more cost than any regulatory. But that's ultimately, as investors, that's where our capital is supposed to come, is to actually offset that. And that's the growth element we see around the opportunities today, is more focused on making sure that supply-demand balance is met, and do that around assets that are not just in time.
And you're in the venture stage. What's your perspective on reporting requirements and affordability and need for additional?
So clearly affordability is always part of the discussion when we look at the business model of what they're producing, right? And like David said, you go back to your customer, and all customers are different. Like your C&I base versus your residential, there's different cost sensitivities to that. So when we're evaluating a business plan, whether it's for CCUS or whether it's hydrogen or RNG, like we have to see something that pencils to affordability that's better than the natural gas prices. If it's inconceivable how they're going to get there, or the assumptions on how they're going to get there aren't justifiable, that's when we're playing into the affordability card and
you're
not
saying
going
that
mixed.
your investments, this is lower than the prevailing natural gas price? You're contributing to...
Yeah, when we see these things at scale,
Yes.
we know if you're going to, natural gas will always be there, but then the natural gas system will have additional products. Those additional products, like that's going to bring in RNG, hydrogen, even CCUS in certain situations, better enable a cost parity that's as good, if not better, than the core product. Because there are going to be those certain customers that will pay certain premiums, but at the end of the day, you've got to beat the market. And if you can't beat the market for your customers, then it's probably not a good business from the venture side.
And customers will see that. I mean, they look at it. They look at it as full system cost as well. I mean, there's a reason why they care about the full system cost when it comes to, when you see the hyperscalers contract directly with nukes for baseload power.
Yeah.
They're doing that at above market rates. They're doing it for a whole host of reasons, including what they would consider that full system cost. And to us,
full system cost in the short term, or full system cost over some longer term?
They're doing those 20
both?
years. So I think you're looking at, hyperscalers are not looking at a peak need for demand. They're looking at a base load into the future view of demand. So, they're becoming the largest energy consumers in North America, and they know that. And so they're trying to get ahead of that as far as what their base needs are, because they view it as a technology race on who can build the best large language models. And to do that, they know they need power. And power is the constraint. It's not technology. They need access to more power. So they're actually becoming a really good long-term customer for the broad, if done well, for the broad consumer, because they're going to induce a lot of infrastructure build that the regular consumer should get the benefit of if done well.
And who's going to pay for that? Are they paying for it?
Yeah,
are they really paying for it? Who's really paying for it? I'm just curious. I don't have an answer. I'm just asking.
I think they're paying for it. I think they want to pay for it because they're concerned with NIMBY issues. They're concerned with, they do not want the consumer to wake up to higher power bills. They want to be seen as an advocate for not adding to that. So I think they're actually very politically sensitive to that point. So, and they're the $1 trillion companies. They're the ones who can't afford it.
And do you see them working with regulators? What's the behind the black box discussions that they're having with regulators
I think
we should know about?
Everyone's having discussions with regulators, whether you're an early stage company at the earliest TRL or whether you're a hyperscaler, because that's the important way to get to those end customers and understand the end customer, which is the consumers, because the regulators are in charge of protecting them. And so there are very frank discussions going on about what are you going to do for my personal geography? What are you going to do for my community? What does that look like? And at the end of the day, because the energy and the power is so important to them for their base case and for what they need to do, as their customer, they're willing to pay for these things.
All right, thanks so much. One final thing that you would like to share with our audience here at the North American Gas Forum and the Energy Dialogues.
And I think the last thing I'd like to share is the importance of innovation to the natural gas industry and the future of the energy expansion. As natural gas grows, the innovation supporting the industry needs to grow with it and enable it to reach its next levels.
Thanks so much.
Our view is that you need to take a practical approach across all aspects of energy. And for us, in the hard asset infrastructure perspective, that focus on practicality has always led to better investments for our investors.
Thank you so much. It's an inspiring time to be in energy and technology, energy and innovation and growth. So appreciate very much the opportunity to be here with you.